Welcome back to Morning Trade Live. We focus on the big picture ahead of the opening bell. Jim Bianco, president of Bianco Research, is with me. And we saw records in this last week. We saw the V-shaped recovery. Tell me a little bit about your thoughts on what really was the catalyst over the last few months, and does that continue?
Yes, I think the catalyst over the last few months was that the economy is improving, that tariffs are not going to be as big a drag on the economy, and that the expectations in the market, at least this morning, are that that's going to continue, despite the fact that President Trump sent some letters over the weekend that he wants to hike tariffs to 30% on the EU and Mexico and some others. It's not slowing down this market. They're not viewing tariffs like they did in April as an existential crisis. As a matter of fact, tariffs are now kind of viewed as a minor thing. So without tariffs getting in the way, I think the economy is looking like it's improving.
It's looking like it's improving. What does that mean for the Fed at the end of the month? I mean, there's certainly been ramped up pressure on the Fed to issue some rate cuts.
I think there's tremendous pressure on the Fed right now to do nothing. The probability, let's just start with the market. The probability that the Fed is going to cut rates at the July 30th meeting is 7%, or 93% that they're not going to cut rates. For the September 18th meeting, which is the meeting after July 30th, it's down to 57%. It was 90% 2 weeks ago. So all these rate cuts are disappearing because they are not necessary. And further, I'd say if the economy is doing well and the economy is rebounding, you would have to ask, where should rates be? And the answer, at least on the long end of the yield curve, is around 5%. And the 30-year yield is at 4.98. It's exactly where it should be. I know President Trump holds a different view about interest rates, that they should be lower and that lower is always better, but that's not the way the market views it. I think the market thinks that they're right where they should be.
That's interesting. So where is the opportunity for investors at this point?
Oh, I think the opportunity is in picking up yield, say in things like mortgage-backed securities and the like. And I think that the risk for us, to throw the other side of the equation into it, is that the economy rebounds. Tomorrow is the CPI number. The risk, I think, with the CPI number is it's a higher number than we expect, than a lower number we expect, because there's some risk that we could see tariff-induced inflation filter into that number, and that could push yields even higher. As far as the equity market goes, the interest rates are your discounting mechanism. So every time interest rates tick up, the stock market becomes a little bit more overvalued because of the higher interest rate. So that's going to be a challenge for the stock market with the record highs and near, very frothy valuations, that higher interest rates would even push those levels even higher.
So where do you search for yield? I mean, people have done so well with short-term bonds, for example. Where else can you get yield at this point?
Well, one place you could get yields is in corporate bonds. And I only throw that out to start with, that I would kind of shy away from corporate bonds at this point because they're tied with the stock market. If there's a correction in the stock market, they'll underperform. Mortgage-backed securities are a good place to get yield. You can get yield at around 7% or so. And in a mortgage-backed security, or 6%, 6 to 7% to be more specific. And I think that there's an attractive place there. The other place I think you could see yields, you could get attractive yields, is emerging markets. I know they're a little bit more speculative, and overseas, the weakening dollar has definitely helped. And especially in emerging markets, you could get 7 or 8% yields, and you have a weakening dollar that has been working for you. In fact, in fixed income land, emerging market debt has been one of the best investments that you could have had for 2025. So those are probably some of the places you could do. Now, if you don't like that risk, as you pointed out, you can go to the very short end of the yield curve in the United States and probably get somewhere around 4 to 4.5% yield with very little risk.
What about equities then? So those are some good fixed income ways to do this. And then what about in equities?
Well, the problem that equities are facing right now is you cannot make the case that there's much of value in the stock market. Everything is either fully valued or overvalued. And the problem you're going to face now is you're making an argument on momentum. And that's a very good argument. somebody's going to buy overvalued stocks and they're going to push them even higher. I think that's been the case for the last 3 months. I think that might continue to be the case. But the problem I see with the stock market is while it can continue to go higher for a while, it's going to run into a valuation problem, in that it is going to run into a problem where you've seen that, at least you've seen it with ETF flows. Professional investors have been net sellers of the equity market for a couple of months now. Retail investors, momentum players, have been huge buyers of this market. If that were to continue for a longer period of time, I think that the stock market could run into some trouble. Not like April trouble, but maybe peak out and, churn around sideways or so. It's up about 6 or 7% for the year. And I've kind of, penciled in the idea that the average return for the next several years will be about 6 or 7%. So I think, as much juice as you could squeeze out of the stock market for this year, I think it's just about there right now.
And it's interesting because last week we did have a down week, even though we saw records for the NASDAQ. On the 3rd, we saw a record for the S&P, but last week actually clocked in a negative week. Do you think the major averages continue to climb the wall of worry? I mean, I know you said stocks are fully valued and in some cases overvalued. Does that stop, the push for moving to new highs, or do we see new highs again and again between now and the end of the year?
Well, last week it was interesting because it was, as you pointed out, everybody was very positive about the stock market, but it actually had a down week. And one of the things that caused the down week was Friday. And Friday, what you saw a fairly substantial rise in interest rates. The 30-year yield was up 9 basis points, and that's a pretty good move, especially on a day when there was no real economic news. And that, I think, weighed on the stock market. And I think as rates continue to move up, that is going to weigh on the stock market. Now, go off in a little different direction on you. I think the biggest risk that investors face right now is this new line of attack that Donald Trump has opened up on Chairman Powell, that he has mismanaged the renovation of the Fed building in Washington, D.C., that he misrepresented it to Congress, and that will give him a reason to fire Powell for cause. And I do think that is starting to show up in the bond market is a real worry that Trump may have found a way to get rid of Powell and may in the next few weeks or month or two move on actually doing that, where just at the beginning of last week, no one was thinking that this was even going to be an issue. And now it's not risen to the point where it's likely, but it is moving. The odds of Powell being fired are increasing, and that's bothering the bond market. And in turn, I think cast a pall, especially Friday, on the stock market.
Yeah. All right. Well, thank you so much. It's good to see you, Jim Bianco. Always a pleasure. Thank you.